Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's going to be related to commodities, financial topics, or wealth building. I'm going to give you my financial opinions, and if you need any help with anything, check out finding-value.com. That's where we go over individual companies that are commodity related. All right, so let's dive in there and see what people are talking about. If you want to follow me at finding_finance. So, starting off with North American LNG export capacity is going to increase by 2x by 2025. It's supposed to be billion cubic feet per day, are equivalent to around 50% of Europe's natural gas consumption. Gas price in the US, $3.5. Gas price in EU, $53. This is a 15x difference. Gas will flow to Europe and to Asia. So this is 2024 to 2025, practically doubling North American natural gas capacity. Here are all of the LNG terminals, liquefied natural gas export capacity that is coming out in the future. You can see just how much we're at about, 11, 12, and this is going up to almost 25 by 2028. So we're going to just about double our export capacity in the next 4 years. Now, there's people who think that we don't have the natural gas to export. I don't know if that's going to be the case, but price is going to determine how much we can actually export. Because if we get linked to the EU price, which is more, $53, and we're at $3.50, and let's say we go up to $10 or $20 a million cubic foot, we're going to see who can produce what very soon. So that's also why I'm very bullish on natural gas. I think Henry Hub is drastically underpriced. And when this export capacity comes online, I think there's a big opportunity for a lot of the natural gas producers to make a lot more money than what they currently are. So anything with the existing infrastructure in North America, I think there's a terminal also going up in Canada there. That's LNG Canada. So some of the Canadian, there's 2 Canadian LNG export facilities going up, which will also help the pricing in AECO. Someone asked me, where are we in the cycle of market emotions? Well, I can give you my opinion. I think that the overall markets, the S&P 500, is in complacency. And looking at it from a big picture view, scrolling in, I think this is if you look at the real estate cycle, this is the bottom of the real estate cycle. This was the peak of the beginning of the expansionary phase of real estate. When you go into an expansionary phase of real estate, interest rates kick up, and the stock market generally goes sideways to lower under that period. So you get these movements sideways. This was an expansion phase of real estate. This was an expansion phase of real estate, and this will be going into an expansion phase of real estate. So if that is the case, I think that we are in the complacency for the S&P 500. Conversely, I think that commodities are just getting started. I think gold is just breaking out, and we've got a big move ahead of us. That is where the opportunity is. Gold, silver. Here we are. There's gold there. There's silver there, ready to rip. Platinum is going to be another one that's a really big opportunity. This is your consolidation in the recovery phase of real estate, and then expansionary phases, they generally rip. So I think this is set up quite well for gold, silver, and platinum, and obviously crude oil. That looks fantastic. We've got the consolidation here. There's your 1, 2, 3 hump consolidation. And then we've got the breakout of the pattern. There's your breakout. There's your retest. And this is generally where I buy. I also bought down here. So yeah, I think we've got commodities about to outperform. The S&P 500, that's what commodities divided by the S&P 500 looks like. So we're down in no man's land for commodities in terms of valuations. It's uh, very good valuations for commodities. So I think commodities are in the disbelief phase. So complacency for the overall stock market. We've had a little bit harsher move in bonds. So bonds might be in denial or panic. I don't know if it's capitulation yet. It might be, but they've had a big old move lower for bond prices, and it looks like it's going to try to base out at some point here. And the market conditions may be good for that. So they could be at anger, even though we haven't gotten that bounce yet. Usually you get a bounce. Well, yeah, you could say we're at the bottom of anger, perhaps. This is probably anger. So if you look at anger, you get this bounce, a little hump there. That's this hump here. And then we're probably going to bounce and move upward. What's going to cause that move upward? It could potentially be recessionary fears, something in the market that could cause that. At that same time as this goes up, whenever that does, gold generally goes up with it. And gold is positioned for that move. And that generally also aligns with the inverted yield curve. This is inverted when it goes down like this, the way I've got it. And then when it uninverts, goes up, that's when gold takes off. And potentially you could see interest rates go down. But here it is moving on up. And we'll see if there's any sort of sustainability behind that. So disbelief for a lot of like uranium's in disbelief, oil's in disbelief. Nobody gives a crap about it. Everyone else that's in Nvidia, they're all in complacency, probably ready to almost be in anxiety very soon. You guys seen the Nvidia chart? Jesus, look at this thing. To me, it looks like we are putting in a topping pattern, and we are playing with fire right now. Actually, I'll move it this way. We're playing with fire right now if this thing really breaks to the downside. So again, that doesn't look all that hot. That looks like a topping pattern to me. More news here is today the Russell 2000 closed below its 2022 low. Its lowest close since November of 2020. Think a stock index with no magnificent 7 stocks is now 28% lower than its 2021 peak. This looks pretty rough here, guys. We can see that the overall breadth of the stock market is doing pretty poorly. That generally indicates that we could see a pretty big pullback in the markets. And that could impact commodities. I'm not saying that it can't. Commodities are obviously outperforming the S&P 500, but again, we could see at times, depending on how strong the sell-off is, could see it pull back a little bit in certain sectors. This guy says a pack always beats the lone wolf. Do you agree? I would disagree. It does not always beat a lone wolf because it depends on what the pack is. You didn't define what a pack is. Now, I've been in a lot of groups where I've done projects, programs, study groups when I grew up. What I found is in some of my classes, you have to identify what you are. Are you the leader? Are you the person who understands the subject? Because really what you're doing, if you go to a study group and there are a bunch of kids that are in your class and you're the one solving all the problems, you're just teaching everyone else to compete against you. I found that out pretty quick in some of my classes, and I just became a lone wolf. I didn't want to do study groups anymore. All they did was try to learn off me. And if we're competing for grades, I don't see why I would give my competitors the answers and show them how to do the work. I'll do that if we're not competing in the same class. But that happened to me in dynamics, happened to me in calculus and all that stuff. I'm not saying that I can do that stuff anymore, but I had, in one of the classes, I think I only got one problem wrong in Calc 2. Yeah, it's I do not believe that. I think it highly depends on who is in the pack and what the pack is about. I have found that it's really annoying if you're very, like, let's say you're very competent in something and someone else is not competent. It's so much faster just to do the work yourself and be like, look, dude, just sit on the side, twiddle your thumbs. I got it. Or vice versa. If I'm fumbling something and someone else is very competent, um, a pack doesn't necessarily mean that you're going to be better than a lone wolf. But it depends on what you're doing, and it depends on the competency of the pack and all that stuff. There's a lot of different things, but it doesn't always beat the lone wolf. Nvidia, are we now entering stage D? This is for Nvidia. I showed you that picture. This is the Wyckoff distribution. Technical analysis. And it looks very similar to the Wyckoff distribution, the way that this thing looks. He's got it labeled, PS coming up. He's got the CZ is this over here, LPSY here, and then maybe perhaps D. And this is a distribution where you've got a bunch of people running into the market that's retail, chasing price performance, thinking that you want to buy the dip. And what the professionals do is they create that emotional move higher, that big move higher, get all the retail guys to get sucked in, and then they offload their shares to the retail sector. And when there's no more buyers left, it just rolls over and dives. Is that the case? I don't know. I wouldn't be buying Nvidia up here. I think it's absolutely overpriced, and the risks there are tremendous. With a PE ratio, I think it's over 200 or whatever it is. It's very high. I'll just say that. With the size of the company of where it's at as well, it's over $1 trillion market cap. At least it was. Here's Brandon. He says, my latest essay on copper, uranium, and net zero. Commodity investing is all about supply-demand imbalances. Specifically, it's a function of the magnitude of deficits and the key drivers of supply and demand. I will have to respectfully disagree. It is not all about supply and demand imbalances. You may think that, but that's not been the case, and I will explain why I think that's the case. What we've seen in history is the entire commodity group go up and down together. If that is the case, that does not mean that supply-demand imbalances of individual commodities are driving the price movements. What I have seen is that credit expansion and increasing interest rates, which is, I should say, inflation. So inflation and credit expansion is what is causing the movement in commodities. What happens is people who own bonds do not like a real negative rate, which means that the inflation rate is higher than the rate of the interest on the bond. So they say, you know what? I don't want to own this. I'm going to sell it. And what you get when you get a large inflationary surge with increasing interest rates is you get a sell-off in the bond market, just like you see right ahead of us. That's the sell-off in the bond market. That money now has to go somewhere else. It's not going into bonds anymore. And what generally happens next is the interest rates will come and impact your S&P 500 where that starts to sell off. If money isn't going into the bond market and money isn't going into the stock market, well, where is it exactly going? And what's happening is people aren't going to sell something that works. They're not going to sell something that works. And what happens is, over these periods of time, here it is right here in front of you, this period, this period, this period, and this period that we've got coming up. Those are periods where stocks and bonds did not work that well. They definitely didn't work in this period here because that's when we had a very large increasing interest rate environment. And that's really what we're looking for. We're looking at, let me put this on another new pane. There we go. So when we look at this area here had an increasing interest rate environment. So what happened is bonds and stocks both rotated away from those assets. The holders did. And they had to because they were sitting on losses. It forced them to do something. It forced the human to get out of it because it's like, if you're going to stay in this, you are going to lose money, period. So what they did is then they chased returns in other sectors. They went over, they sold their bonds, they sold their stocks, and then they bought precious metals, they bought crude oil and the equities associated with all that stuff. It was not the supply demand imbalances in each of these commodities. And that very well may be the case, and that very well may be a huge driver and contributor to inflation. To completely agree. But historically, what has generally occurred is a larger demographic coming into home buying years, and it's forced the entire landscape of investments to rotate differently and change. And that is why we see these slowdowns in the S&P 500. That's why we see an increasing interest rate environment like we've got coming on here recently. And that's why all of this aligns. It is not the individual commodities supply demand imbalances. And generally what occurs is that inflation that comes into the system is what puts it into an imbalance, because now you have to increase the production of commodities. And what that exposes, it exposes the supply imbalances, because your demand, which is the credit growth, is going to show or uncover the supply imbalances in all of the markets. Because now money's going to rotate into it. It's going to rotate from a demand perspective, and it's going to rotate from an investment perspective. Also, countries are more inclined to buy commodities now that bonds are losing money. So they'll even shift and start to basically restock their inventories. And that could be China and whatever else. It says, why do investors need not believe in a higher oil price to be very excited about the value proposition in energy stocks? Why can we see the faint glimmer of the beginning of a multi-year bull market for natural gas? Tune in today at that. And we already went over the dynamics of the natural gas market and the gigantic capacity that's coming on for liquefied natural gas. You know, if I were to pull up natural gas, here, if I were to pull up, yeah, okay, we'll pull up natural gas here. Natural gas it just recently broke out, guys. Look at this. It just broke out. Bam, right there. So we've got all this capacity ahead of us. Natural gas, when you look at it from a ratio perspective, is cheap against all the other assets. And it's breaking out again in the United States dollar here. It's breaking out. TTF gas is also breaking out to the upside as well. This looks absolutely fantastic for natural gas investments and for those who are long-term investors. Peter says the next few weeks could prove to be an extremely poor interval to be short crude. Don't take that risk. Well, that's his opinion. And I'm not shorting crude. I'm just sitting in it. This is Amy, and what she said is, I've yet to see a housing take on the infamous 9-to-5 girl. Here it is. Her problem isn't the job, it's the commute. She can't afford housing close to her job. As long as the labor market is strong and housing unaffordable, people will push for remote work or choose gig jobs. And this person's crying about why they can't buy or whatever. I'm going to be honest here, guys. You're not supposed to be able to buy a house right when you start working. It's not supposed to be that way. It wasn't that way for me, and I don't think it was that way for a lot of people. It's not like right when you start getting, right when you get your first job, that you just go out and buy a house right off the bat. I don't know of anything that's like that. And yes, some of this is going to be crappy. Working a 9-to-5, oh, I don't have a lot of free time. Guess what? That's what it is. Her problem isn't, it's the commute. Well, guess what? If you can't afford to live where your job is, then don't take the job. This is not rocket science. It's pretty easy. I had to move to where I had a position and I had to rent. I rented for a long time. I had to rent for a while. I even moved back with my parents for a short period of time to save money to buy a house. That's what I did. And I had to first gain the experience, move back to California, or stay in California, I should say. I went to school out in California. I moved all my stuff back to Minnesota, and then I got a job shortly thereafter in California. And the cost of living and how much I made was really rough. And you know what? I needed the experience, and that's what I got. I got the experience, and I got the heck out of there to go make money at the same pay rate at a spot that's half the cost of living. And then I moved again after that to where I am today in Colorado. And that took many years of doing all that. It's not supposed to be easy, and it's not supposed to be convenient. 9 to 5 jobs, or jobs that are 7 to 3, or whatever it is. I worked 6 to 2:30 in a lot of my jobs, but yeah, I didn't like it, but it's something I had to do to get where I'm at. Peter says even gold stock investors don't have a clue what's about to happen. Gold is up over $9, trading at roughly 2,000, and looks poised to blast off to new record highs. Yet gold stock investors still expect the price of gold to fall as bond yields rise. Inflation will cause both to soar. So there's some people in the camp, and there's a big split here. Some people think that interest rates are going to go up, and we're going to continue to have inflation. Then we've got another camp that thinks that we're going to go into a recession, depression, deflation's coming, and that this whole thing's going to crash. And in my opinion, I think we're going to have both at different time frames. I think we could have a slowdown, which could happen very soon. The yield curve uninverts, and then I think we could have inflation and bond yields rise at the same time after it. That's a guess, though. I don't know for sure. Could the yield curve, stay inverted for a long time? It's possible. I know some people think that it's going to uninvert, that gold's going to rip it, silver's going to rip it, and that we could see a slowdown in the overall markets from the interest rates basically coming into effect, causing foreclosures and bankruptcies in companies and whatnot. And again, I could believe both sides. If I were to take one side over the other, honestly, guys, I really don't know in the very short term what is going to happen, over the next 6 months. To me, it looks like the yield curve wants to uninvert, which then places us in the cycle of a mid-cycle wobble. Because I know we haven't built those homes. We do not have high inventories or not. Now, could the stimulus money, is this like a stimulus overhang that we're going through? And then once we cleanse that out, the real estate market is going to continue to move higher as the psychology of the individuals say, you know what, I don't think interest rates are coming back down. And then they go and they save more money, they put larger down payments, and they continue to buy homes. And then they go and buy new homes because if the existing inventory isn't there, they're going to continue to buy new homes. That could also be the case. I just don't know if we're going to have a slowdown in the short term. I could easily understand all parties and all of the differing opinions around it. And here's another thing. We can still have energy go up even if the yield curve uninverts to some extent. And it depends on how fast it uninverts. It could take a year or two for this thing to really slowly uninvert. And it's a very tricky thing to get perfectly right. And I don't think any of these people that I read are going to get it perfectly right, including myself. I'm not going to get it, completely and perfectly nailed. But looking at supply, looking at demand, looking at what is happening to bond markets, they could easily come in here, sacrifice the dollar, and print a bunch of money to save the bond market and sacrifice the currency. So it could go any way. It's in the hands of people, and I think eventually it's going to end in inflation no matter what. The path there in the short term, I just don't know what the path could be in the next 3 to 6 months. If we get a slowdown, I think the response could be yield curve control, printing more money, and whatever the response is going to be, it's going to be printing more money. That's really what it is. Here's bullish trend. He says Natty, not much resistance till $5. So we could see a big move to the upside in natural gas. Totally agree. Here's a warning from Katusis that the traditional 60-40 portfolio is dangerously close to breaking a 15-year uptrend. And this is going to break to the downside here, guys. It's going to break to the downside, and this 60-40 portfolio is going to get crushed. That is future commodity and precious metals buyers right there. That is what's going to force the rotation, is going to be losses. And people are going to get fed up with losing money. And they're going to say, you know what? Just sell it and move it into precious metals or commodities. That's what I think is going to happen. And it's going to, commodities and precious metals will be adopted by more people as time goes on and as the losses pile up. Grady says the Dow versus gold ratio is topping big picture. Said would see a yellow breakdown and backtest. That is now done. Breaking away now from backtest as expected. Chart means gold will outperform stock market going forward, and that capital flows are moving towards precious metals. And that's exactly what I've been talking about the big rotation of money. I've been saying that since, 2020, 2021, that we're going to see a big rotation of money out of technology and out of the stock market and a lot of the bond market into commodities. This is the shoulder head shoulder in the ratio here for Dow Jones versus gold, and gold's going to outperform and push that ratio lower, meaning that gold's going to outperform Dow Jones. We're also going to see commodities do some crazy stuff. All of this. So here's another thing, just so you guys understand this. When we go through this topping pattern, it generally takes a couple of years for this to go through. This is a very big, long topping pattern that we've got. And it's going to accelerate towards the end of the bull market for commodities. So it kind of sucks in the beginning because you're riding through things. It's kind of boring and it goes sideways for a little while in certain sectors at certain times. It will speed up and accelerate with time, and then the returns will really accelerate. So just be patient, wait for this stuff to come and turn, and then wait for the money to rotate out of the 60-40 portfolio, bonds and stocks. It just takes time. And interest rates to kind of grind all this stuff up. I shared this with Kevin. He thinks he's in the sell-off camp, the recession camp, and I understand all their viewpoints. He says, sell the news. We're in a bear market, and the shit's going to hit the fan. Year 2000 like meltdown recurring 23 years later. This is the NASDAQ bubble. So he thinks that we are like 2000, 2001. I've brought that up with the people on the website. I think that we could be in like that time frame based off where the yield curve is at, based off of the producer price index versus the SPX. All these different things are pointing to a 2000, 2001 era. He says, we are now at the failed recovery wave, just like late 2000. The internet did go on to be amazing, but the stocks still got smashed. AI will be incredible, but the stocks are going to take a beating. Rates this high will lead to a meltdown. Even the Fed government will be bankrupted. This meltdown will happen. Then we get panic cuts, and the Fed will choose inflation over complete destruction of the financial system. Inflate the debts away. Panic into gold and silver. Get ready. And that is exactly what I think could potentially occur. It's a slowdown in the markets, and then they print. That's all they can do. They print. And I think I showed this one last time. Tell me how these dates all align. So we'll stop there, even though this is pretty cool. 31/69/2022, 31/69/2022, and that's right when the commodity to stock ratio is all perfectly aligned and cheap. So that's where we're going to stop it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got. Everything that I see is still good for commodities. Could we get a slowdown over the next 6 months? Very possible. I'm not going to try to time it. I'm going to ride through it. Is that brave or stupid? Put in the comments section what you think that is. I'm going to ride through it. I'm not going to try to time this stuff. I don't want to be left out by any means. It's hard for me to buy back in if the price is a lot higher than where I bought it. I'm just going to leave it and ride it. And I'll accumulate other assets. I think precious metals will do really well from here going forward. So I'll just accumulate those on top of the stuff I already own. So that's what I've got for today, guys. We'll catch you guys later. This is Finding Value.